I just wanted to welcome everyone back to this fourth and last session of this Climate Risk Insurance Day. And I would like to thank CEAR and the whole team and all the speakers and panelists for participating, taking your time preparing this. And I'm looking forward to that session. Thank you.
Okay, thank you very much, Dirk. Glenn Harrison here. Unfortunately, we are unable to share video, so all of the effort I went to have a shower and get changed and look properly dressed up to look the part won't be anything, but that's okay. This is a great session on a project that has been implemented to look at insurance, inclusive insurance, specifically index insurance. We have a good set of panelists. It's the QUIIC session, Quality Index Insurance Certification session. You can see the speakers here. We have one apology, Hassan Bashir, who is listed there, will not be able to join. He's just literally an hour or so ago had a death in an extended family and cannot join us, unfortunately, but we'll be using his time to talk about some of the issues. So let's go on to the next page, Nick. Okay, just want to remind everybody that we're going to be taking about 90 minutes, and that'll include Q&A. We have plenty of time at the end for questions and answers, so feel free to use the Q&A feature as indicated. We'll select the questions towards the end. We will ask everyone to keep their microphone muted. Everyone's now familiar with the usual protocols with Zoom, I'm sure, at this stage of our shared lockdowns. The session will be recorded and will be made available online. So please be aware of that when you're saying certain things, and that I'm sure I'm saying that as much to myself as anybody else, but just be aware it will be recorded. Okay, Nick, next page. So welcome, let me welcome you to the session properly now. This is a Quality Index Insurance Certification session. It's a part of the International Conference on Inclusive Insurance, as you know. Let me see if we can activate the videos. Yes, you can see me. All right, we can now activate the videos. That's good. So we're back on track. My name is still Glenn Harrison, and I am director of the Center for the Economic Analysis of Risk, which is the co-host of this. So you can see all of the parties down at the bottom that have contributed to this work. I'm sure Michael Carter will talk about their individual contributions, and you'll be hearing from several of them during the session. So let's go on to the next page, Nick. I really just want to introduce first the objectives and the overview. The fundamental question is, how do we evaluate and certify the quality of index insurance contracts? We have a lot of index insurance contracts being proposed, going before regulators, going before governments across many, many, many countries. And there is a concern that some of those are good contracts and some are bad from an actuarial perspective, from a consumer welfare perspective, and in terms of meeting social objectives. So the goal, the broad goal here is how to come up with a systematic method of certifying the quality of index insurance contracts to guide decision makers, whether it be regulators or government agents or people who are designing products themselves. So it is a rigorously motivated policy exercise. It is not an exercise where we just try something out and see if it works. And I have no idea actually what that expression means, but it drives, sadly, a great deal of the evaluation work that's done in development economics. As Michael will explain, this comes from applied welfare economics, so there's rigor behind the methods, but it is designed for governments and regulators. It's not something that's designed for academics. It's designed for governments and regulators that care about more than just solvency issues when they're evaluating contracts that are proposed. That's one of the issues that we face repeatedly in domestic insurance regulation around the world, and certainly here in the United States, but in many, many other countries where the regulators pay lip service to the quality of the contract, but practically spend most of their energy just focusing on reserving and solvency issues, which are important to be sure, but are just one aspect of the quality of an insurance contract. So the plan for the session, let me introduce the people generally, and then we'll go through them, is Michael Carter is a professor at the University of California. He is the leader of this project overall, and a major force in research in index insurance contracts in developing countries for many, many years, actually for quite a few decades. Lilian Ndungu is the thematic lead from the Agriculture and Food Security Regional Center for Mapping of Resources for Development. At the moment, she has not been able to join us for some reason, so we're just hoping that she will join us in time. Otherwise, we will take up her time. Michael will fill in some of the issues that she was going to talk about. Hassan is the Executive Director for the Agency for Inclusive Insurance Development in Nairobi, Kenya. I just explained that he will not be able to join us, but Michael will be filling in on some of the topics that Hassan was going to talk about. And then finally, Munyaradzi is here from the Uganda Agro Insurance Consortium, and he'll be speaking for about 10 minutes. So given the absence of Hassan, the speakers may have a little bit more time, and then we will have 30 minutes of Q&A. Okay, and this now takes us to Michael Carter. I hand it over to you, Michael.
Okay. Thank you very much, Glenn. Glad to get the video working, and you're as good looking as you.
Just a quick thing to interrupt, Michael. Sorry, Lilian has joined us, so go ahead.
Oh, great. Good. Okay. Welcome, Lilian. So let me thank everyone for joining us today. Let's see if I'm going to be allowed to share my screen. Sorry. Okay. Can everyone see my screen with the slides?
Yes, we can. Yep.
Okay. Thank you. So let's jump right in. So I'm here to sort of kick off this conversation, and on behalf of my colleagues who will be speaking with us on the how and why of measuring index insurance quality. Again, as Glenn already mentioned, QUIIC is a joint effort with the other partners who will be speaking with us today, and others representing both the government sector, the regulatory sector within East Africa, as well as other insurance companies. The logic we put forward here was for me to explain a little bit of the background and the conceptual framework that we're using, and then Lilian will speak a little bit about the actual implementation of the concepts as she works with what we call the QUIIC certification lab. And Hassan was to join us speaking from the private sector perspective, and Munya works for the government of Uganda, actually in sort of a public-private partnership around agricultural index insurance. So this project owes a lot to a number of people, and it's, as Glenn said, it's something we've been highly motivated to do for quite some time. It's still a work in progress, and we really very much appreciate your attention and attendance on these issues. So let's jump right in. So let me first talk about the good news and the bad news here, if you will, of index insurance. Let me see, my little pen isn't working. I don't know why these things are as difficult as they are. Well, I won't go with it. Okay, so first, the good news about index insurance. The good news about index insurance is that it does not pay based on verified individual losses, but instead pays based on a cheap to measure index that is correlated with individual losses. So examples are average yields within say in a county or some other geographic zone, or rainfall within some district. The reason this is such good news is for low wealth people, conventional insurance is usually not cost effective. Premiums are low because wealth is low, and the cost of visiting, especially remote rural people, and verifying losses makes it often prohibitive to implement these kinds of contracts. And yet we know it's people in these kinds of locations that often suffer the most from risk, whose behavior is distorted. As I like to put it when I'm talking about poverty dynamics in rural regions of Africa, is risk can make people poor, and risk can also keep people poor. So there's a lot to be gained if we can find a way to deliver insurance, and in index insurance, the good news is it can deliver it. And indeed, the research that is out there shows that when index insurance works, it actually realizes its potential. So farmers who are underperforming, underinvesting because they can't risk the sparse savings that they actually have. We actually see when index insurance comes along, they will often increase their investment in ways that may increase their income by as much as 25%, right? So that's with no technological change. It simply says people's behavior, their sort of risk avoiding behavior without insurance was an extremely costly enterprise, or way to run an enterprise, if you will. They were effectively giving up as much as 25% of their income in order to take away a risk. So I think that's important to keep in mind, that that this is potentially really a game-changing kind of product for individuals. Now, that's the good news. What's the bad news? Well, the bad news is actually exactly the same as the good news. So the bad news is that index insurance does not pay based on verified losses, but instead uses an index. And the bad news is sometimes those indices, while they might be correlated with individual losses, they're not identical to them. And that opens the door to two kinds of false readings or false determination of losses. The first is what I call false negatives. So that's the case in which an index says, oh, no loss occurred, and yet the farmer actually did have a loss, and the farmer is not compensated. So obviously in that kind of circumstance, as some of you may know, Daniel Clark, who works a lot on index insurance, he said, when you have index insurance, the worst thing that can happen to you as a farmer is the worst thing gets worse, okay? So without index insurance, the worst thing that can happen to you is you have a crop loss, a total crop loss. If you have index insurance, the worst thing that can happen to you is you have that same crop loss, but the index has a false negative and you don't get compensated. So not only did you lose your crop, but you lost the premium that you paid. And this is a real quality issue. The other thing, part of the bad news, is the other sort of failure you can have, or false indication from an insurance index, is a false positive. So that is, farmers who do not actually have insurable losses may actually receive a payment. Now, in first thought, that may sound like a good thing. Oh, I didn't have a loss, but I get free money. But of course, it's not free money. Someone paid more than $1 to get that dollar that you received in the case of a false positive, and that's not good business. And indeed, when we look at the pricing of index insurance contracts, a certain, often a surprising fraction of the premium load is related to events when farmers are getting compensated, but in fact, they didn't really need the compensation. So false positives are sort of doubly damaging, maybe triply damaging. They undercut confidence in the product. Farmers say, wait a minute, why are you giving me this indemnity check? I didn't have any loss. And it's not a good deal. The farmer pays, depending on the markup, more than $1 to get that dollar in indemnity payment. And finally, it keeps the price higher than it otherwise would be. So I suspect most people in this session are here because they know perhaps quite a lot about index insurance. And there are actually plentiful examples of what some people euphemistically call basis risk events, where farmers end up having losses, not getting compensated, and becoming extremely unhappy. And so as someone who's been working in this area for a while, we finally said, well, look, we've got to do something about this. So the question is, how do we think about it, and how do we think about the solution? So the way what underlies QUIIC is this notion that it's really an example of a very common problem in a lot of markets, which is the problem that happens when the quality of a good or service is actually a hidden trait. So for me, the easiest way to talk about this is to start thinking about maize seeds. So if you imagine a farmer holding a maize seed in her hand, she can't look at that seed in her hand and discern its genetic potential. You might tell her, or a scientist might tell her, oh, this is a magical seed that's drought tolerant, that will give you yields of 9 tons per hectare. It's all these great things, and the person looks at it and says, yeah, but it kind of looks like a maize seed, right? So it's a hidden characteristic. Similarly, here on my slide, this is a woman in northern Kenya, very happily holding her insurance contract. It's actually one that was issued by Hassan Bashir's company. Now she's holding that contract. She's been told certain characteristics of it, but she can't actually look at that piece of paper and discern the potential of the contract. What's its rate of false negatives? Will it let her down in the time that she needs it most? So it's not visible in that paper. She might be told about it, She might be said, this is great for you. This will help you and your family. But again, it's a hidden characteristic. So when we see these kinds of markets where quality is a hidden trait, we often see some kind of certification or even government regulation as the response to the hidden quality. So if we think about maize seeds, pretty much everywhere in the world that I know, governments actually routinely certify the quality of seeds. They have germination tests and they have yield tests. So again, if we stick to Kenya for the moment, you cannot certify and sell as certified and improve a maize seed where you don't get, at least I think it's 93% germination in a test that the government runs. And they also plant the maize for a whole season, and the yields that occur have to be above a certain threshold, and that threshold is set by what's out in the market already. So the government is actually certifying these things with well-developed criteria of germination and yields in the case of maize. And we know what happens when certification is not done. It's a problem across many parts in East Africa, where if certification is not done or it's not really enforced reliably, then the bad stuff drives out the good stuff within the market. So in the case, if seed counterfeiting gets to be a problem, then no one's going to pay a high price for seed because they say, well, I've heard everything is counterfeit. So that little seed I'm holding in my hand, you might tell me it's water efficient maize developed by Monsanto, but I have no idea if that's true. So I won't pay for it. And if people won't pay for the improvements in the higher quality that is expensive to generate, then the good stuff disappears from the market. So the bad literally drives out the good. And in the case of maize seeds in a number of countries, we actually see productivity takes a dip down, and the economic costs of this lack of certification and implementation of it can be incredibly high. Now, in seed certification in most countries is actually a government regulation, as I mentioned in the case of Kenya. But if we think about our lives and think about different goods and services, we have many instances of voluntary certification. There's the whole set of ISO standards. We have, in the United States, we have the underwriter labs for electrical appliances. We have organic or fair trade for agricultural commodities. So we see lots and lots of instances where quality is hard to discern. And in many instances, there's a voluntary standards, and companies will actually pay for that certification because they want that stamp of independent approval that their commodities, their goods or services are actually reliable. So this is the beginning of QUIIC, this notion that we have a problem of quality in this market. It's not obvious what is good quality and what is bad quality. It is obvious that the solution would seem to be some kind of reliable certification. So what I'm going to talk about in the remainder of my time, and then our other speakers will tell us a little bit more about the implementation. I'm going to actually talk about the definition of quality when it actually comes to index insurance. So as I say here on the bottom of my slide, economics to the rescue, or applied welfare economics to the rescue. And for many people, when they hear economics is coming to the rescue, they run the other way. So I ask you to give me a little bit of forbearance here for just one moment. So how do we think about indexed insurance, and what's quality? So one way to think about it is to start with this diagram here on the right side of my slide. We know what good insurance looks like, right? What good insurance is supposed to do is put a floor underneath the farmer, say in this case. So this is actually a case of imagining we had a perfect index insurance or a perfect insurance contract for a livestock herder in northern Kenya. The green dots there are actually draws from the actual probability distribution of what a livestock herder who starts off with $1,000 in assets. And this is what could happen to her in any given season, right? As you can see, some of those dots, that $1,000 of assets may drop below $400, right? So that's like a 60% loss in herds that can happen. Now, the red line there would be the set of outcomes the farmer would face without insurance. With perfect insurance, the insurance is going to kick in, say, in this case, I made up an example contract where there's a 20% deductible, and for losses deeper than 20%, then the insurance kicks in and compensates the farmer. So instead of the farmer sliding all the way down the red curve, the nice green line, the perfect insurance line, shows us the protective floor. So that's what good insurance looks like, right? And what we can see is the difference between the green line and the red line. Okay, we're gonna call that's the difference in the assets the livestock herder would end up with in bad years or good years. And you can see in good years, that is when losses are small, the insurance actually gives the farmer a little bit less wealth than she would have without the insurance. That's because the individual pays a premium in the good years and gets no compensation in return. On the other hand, this difference becomes really starkly positive. So in the case where the farmer's assets wealth without the insurance might have been $350, so a $650 loss, you can see the farmer's held at this floor level of about $750. And the whole idea of insurance, of course, is that people are willing to give up some wealth or money in good times. When money is relatively plentiful, the money is in some sense worth less in those good years. They'll give money up in good times in order to get it back in bad years. So for that woman who faces the horror of having lost 65% of her productive wealth in a bad year, money is really scarce for her. She's saying, how in the world I'm going to make do and keep the family together in this kind of circumstance. So as you know, that's the essence of insurance, is moving money, giving up money in good times when money is worth relatively little, and getting it back in hard times when a dollar in fact is worth more than a dollar because of the desperate circumstances that you're in. Now, economics gives us a way to think about how to value. Sorry, I'm getting my first ingestion of caffeine for the morning. Economics gives us a way to think about how to value this. And we have a standard tool in economics called expected utility, and that's just the expected level of well-being a person might have. And we can think of measuring and defining that, and I'll come back to this in just a moment, say a tiny bit more. The expected utility the person would have with insurance, the difference between that and the expected utility without insurance. We can think of that differential as telling us what's the benefit of insurance, what's the insurance benefit. It's that difference. And notice if IB, this insurance benefit, is actually negative for any particular insurance contract, that's going to mean the insurance is actually making people worse off in terms of their expected level of well-being. So a very minimal standard for insurance certification is that it should not make people worse off. Now, I've actually implemented this standard on a number of contracts, and there have actually been insurance contracts sold that fail this test. That is, insurance contracts that fail to actually issue a payment, that have a false negative when those severe events occur. And you've made the person, as I said a moment ago, a false negative makes the person worse off. They'll actually be below the red line. And we'll see some instances in a moment. They'll be below the red line, even though money is extremely scarce. And that's exactly the kind of thing that will damage the quality of insurance. Now, to say just a tiny bit more about it, and I don't want to get too wonky on us, but just to sort of indicate that while economists can talk about expected utility theory, and I could explain it in about 45 minutes, it's actually quite a sensible thing. So this expected utility differential can be approximated by the sum of three very sensible things multiplied together. I suspect if we all sat down together, we would say, okay, what is it that determines whether insurance is of high quality or low quality? And I would say that we would pretty much be easily able to agree that these three things that are listed on this slide are the things that will determine whether insurance is good quality or not. So the first is the difference between my wealth with and without the insurance. So that's just in the prior slide, that's just that gap between the red line and the blue line. And notice, even when insurance is perfect, sometimes that gap is going to be positive, which is the case when payouts are made, and sometimes the gap is going to be negative, which is when payouts are not made. So that's one thing that comes into play. The second thing that comes into play is the probability that a particular outcome occurs. So on the diagram here to the right, the little bars there, these are actually probabilities drawn from northern Kenya. And the height of each bar shows the probability that household assets without insurance will drop down to the level with it we see in the diagram. So a moment ago, I mentioned there was a probability that assets could fall as low as 65% below the starting level. And that's that little bar down to the left. It's only about a 1% probability. It's not a very likely event, but it is an event. And you can see to the right side of the diagram, circumstances in which very few or no or few losses occur are actually much more likely, right? And then the final thing that needs to go in here, so we know delta, this difference, which is represented by the green line, in good states of the world, delta is negative. So the family is made better or worse off with insurance, but it's highly positive in the bad states of the world. So the third component that needs to go into our welfare measure of insurance is how desperate are we when these different states of the world occur? And the blue downward sloping line there is something that economists call the marginal utility of income or consumption. It's essentially the shadow value or the implicit value. It's a measure of desperation. And this is just a standard economic concept. Many of you may have suffered in an introductory economics course where somebody was babbling on about the diminishing marginal utility of income. That's all this is. But the key point here for insurance quality is notice that blue line is really, really high in severe and bad states of the world. So if we go back to that far left block, there's a low probability event that the person might lose 65% of their wealth over the course of a season. And because of that circumstance and those low levels of income, the marginal value of money, the shadow value of money or marginal utility is extraordinarily high, okay? And so what the quality insurance, and those of you who are mathematicians, this is just a first order Taylor series approximation to that expected utility differential. If we have J different possible outcomes, and in the example here, each of these bars represents a different possible outcome, it is literally that expected utility differential is for each possible state of the world, we're multiplying the delta, the difference, the green line, times the probability it happens times the blue line. And if you add those up, that is literally the quality measure. So notice some of these terms are going to be negative because in good states of the world, which happen fairly frequently, delta is actually negative, right? You've paid a premium, okay? But the shadow value of money, if the contract is working perfectly, and this is again the perfect contract case, in those cases where delta is negative, the blue line says the value of money, $1 is worth just $1. On the other hand, in the perfect insurance world where delta, the green line, is well above zero, those things may not happen very much, but when they do happen, they are incredibly important to people as represented by the very high shadow value of money. $1 may be worth, for a family like this, $1 may be worth 10 times as much in a time of need when they can't feed their family as it is in good times. So literally speaking,
about 5 minutes,
what we're working, okay. Literally then, thank you. Literally what we're pursuing here in the QUIIC program is to take these basic economic concepts and say, sure, it can seem like a little bit of mumbo jumbo, but like a yield test for maize or like a germination test for maize, it's actually a fairly sensible thing. It's a way to sort of think through when is insurance value? When is insurance valuable for people and how well does it perform? So the final slide I wanted to show you is not a perfect insurance contract, but this is actually a satellite-based contract now where we're trying to predict the different types of livestock mortality that a person might have. So this has the same probabilities. The dots now represent in these different statistical possibilities how much the contract actually paid, okay? So if you go to the far left, you see the green dot, where on the horizontal axis, that's the one we've been talking about, where the woman would have lost 65% of her assets. And without insurance, her assets would have been all the way down at the black line. And this insurance contract in that instance would have not fully compensated her. So there's a sort of a partial false negative. It wouldn't have brought her all the way up to the dashed floor line that the perfect contract would, but it would have gotten her halfway there. And so the green dots that I've put on these pictures, these are instances where the contract sort of more or less gets it right. The red dots, this is an imperfect contract, right? And the red dots here are actually ones where the contract completely failed to pay, even though the person actually would have had a loss. These are instances when the satellite predictor, and this, by the way, is based on vegetation indices, the satellite index actually got it wrong. Okay, and the blue dots and the purple dots and the yellow dots are other sort of instances that you can see. And the yellow dots, for example, are false positives, where the insured woman is actually getting fairly large payments, but she had zero or very modest kinds of losses. So what we can do with this is taking together the pieces I showed on the prior slide. We know the probability these different things happen. So for example, the red dot in the lower left corner, that's going to be one where that happens not very often, but when it happens, it hurts. On the other hand, the green dot just above it and to the left is one where the insurance really helps. So adding these things up is actually what the welfare metric is doing. And so using this, we can calculate whether or not any given insurance contract, including an imperfect insurance contract, like the one is illustrated here, whether the imperfect contract is actually welfare enhancing for the individual or not. And secondly, so in the first instance, it allows us to separate the wheat from the chaff, as an article in The Economist talking about index insurance quality said a couple of years ago. How do we throw out the bad stuff? Well, this kind of tool will allow us to very easily identify some of the bad stuff. And some of the earliest rainfall index insurance contracts that were offered to farmers in various parts of the world, I've gotten hold of data, and they do not pass this. They fail too much when things are bad. They just are not capturing enough of the real variation that farmers confront. The second thing, though, that can be done is we can use this same measure to judge or compare one type of contract to another. So in the work we're doing in QUIIC, we talk about sometimes the relative insurance benefit. So how much of the benefit is provided by an imperfect contract compared to what a perfect contract would offer. So the contract I have illustrated in front of you here, believe it or not, it doesn't look all that good compared to the perfect contract, but actually from the individual welfare perspective, it achieves about 50% of the gain that a perfect contract would ensure. So it's not perfect. We would have to think about what happens in these red dot instances. How would is there some backup? And if we have a chance, we can come back to that. But the measurement of quality is the first step here. We need to separate the wheat from the chaff. We need a well-defined standard that allows us to do that. And then finally, we need to use these kinds of measurement tools to pick out the best contract. In exactly the same way, a maize breeder says, I know what my measurement is of quality, its yield that a farmer can get in this particular environment. And I'm gonna do genetic selection across maize varieties to find the one that's best by this well-accepted quality standard. And we have exactly the same thing that we can do. So I'm gonna pass it on over to Lilian now, she's our resident rocket scientist on the panel. And Lilian will tell us a little bit more about how she and her colleagues are using these concepts to measure and certify index insurance quality. So thank you all very much, and I look forward to questions as we continue on.
Thanks, Michael. Lilian, you're on mute.
Sorry. Thank you for the introduction. I think I missed part of the initial introduction by Glenn, but I'm happy to present and tell you more about what we are doing as part of this collaboration on implementation of QUIIC. So just a minute. So as Glenn said, my name is Lilian Ndungu, and I am the lead for agriculture and food security at the Regional Center for Mapping of Resources for Development. And this is based in Nairobi, and RCMRD is the is an intergovernmental organization that has been in operation for the last for 40 years. It's actually older than I am. And the goal is to, it was established by the countries in Eastern Southern Africa, around 20 countries, who are known as the contracting member states, with the goal of providing geoinformation services. And some of these services are actually based on the needs of the member states. And apart from the needs of the member states, some are contracted services. So we can have a private company contracting us for service. But maybe the most important thing to talk about is why RCMRD is the implementing partner for QUIIC in the region in Africa. And I think RCMRD has been in operation and already had linkages with existing insurance programs in the East Africa region. This includes the Livestock Insurance Company and the Kenya Crop Insurance Company that is being supported by the Ministry of Agriculture, the government. But again, one of our CMRD strengths is many years and a wide group of individuals with a wide array of technical expertise in using Earth observation and other technologies to develop products for decision making. Again, a lot of data tools have been developed from RCMRD, and again, RCMRD is established as a lead advisory body to governments and other stakeholders. Again, there are a lot of affiliations and partnerships for data, including universities and data producers, Earth observation data producers. But I think the most important point, given the sensitivity of insurance contracts, is its neutrality. You know, RCMRD is non-partisan. It does not have a vested interest in the insurance sector in terms of maybe profit or even any vested interest in insurance. So that neutrality is important. But again, with the existing technical expertise and data repositories, servers and networks, the ability to develop any products that are available and scale them beyond even East and Southern Africa. I think right now, while this map in green represents our contracting member states, right now we have a number of programs that are running in beyond East and South, and we have been expanding and collaborating with partners in West Africa to implement projects. So, and you know, in East and Southern Africa, RCMRD is also well known for its capacity building initiatives. And again, being strategically located as a coordinating partner in the implementation of the QUIIC program. And how we envision that this QUIIC certification process will happen is that we'll have this kind of workflow where we have the users who are the insurance companies and the consortia sending a request for certification to the QUIIC certification board. And this includes the insurance regulatory authorities, other partners who have been engaged in the last 2 years to be part of the certification board. And maybe to clarify that the engagements mainly focused on discussing the idea of QUIIC and getting feedback. And what I can say is that from the first meeting that was held in Nairobi 2 years ago, there was a lot of positive response from the insurance actors in terms of developing this standard. And this is because QUIIC does not compete. It does not seek to compete with the existing processes. Rather, it seeks to supplement the gap. You realize that in the last couple of years, with the advent and availability of remote sensing and other observation products, which are free or available at a low cost, we've seen insurance contracts using other observation data. But then there's no clear way of evaluating if the right data is actually being used for that specific contract. And if the right data is not used, then we are going to have problems in the ability of that contract to be effective. So when when a user sends their request for certification to the QUIIC certification board, then that application for certification is sent to the technical lab. And this is where QUIIC, the whole process of QUIIC, which I'll explain in the next slide, comes in. So the request is sent to the technical lab. This is RCMRD and the UC Davis teams. And then that application goes through a technical process, and then it's evaluated, and the results are sent back to the certification board, and then they send that results to the insurance company that requested for certification. And again, what I can say here is that then RCMRD and UC Davis, or RCMRD, is again bound by a code of ethics in terms of privacy of this data that is being required for informing the certification. So there's that kind of security in terms of sharing sensitive data. Again, what has been happening in the last 2 years is that a working group of the whole actors in the insurance sector have been involved in the consultations. And we've begun testing some contracts where data has been availed, especially in Kenya. So next I'm going to talk about what exactly happens if, for example, an insurance company applies for certification of a specific insurance contract. What happens is that the first level is that there's some data that is required. If we're talking about a crop insurance contract, then we need data, ground data on yields at farmer level and by zone. By zone, I mean the unit areas of insurance. So the first step is to collect and clean this data and then subject it to the process of evaluating. And this ground reference data is used in combination from modeled yield estimates from the index. So we are taking those two data sets and taking them through the process of evaluating the first running the insurance product. So calculating the payouts, assessing the markup, estimating the cost of, estimating the income at farmer level and at zonal level of estimating the income with and without insurance at farmer level and at the zonal level. And then trying to look at the risk aversion. By this, we are talking about there's a way that Michael's talked about it. How desperate is the farmer during a bad or good year? And that is also dependent on their sources of wealth. So by looking at all these factors, then we get the risk-adjusted income with and without insurance and assess if the product is able to cover the farmer more often than not in the case of a bad year. And so this is actually done by using a measure known as the certainty equivalence, which is the risk discounted value of the household income. It represents the welfare and accounts for risk in terms of probability of bad events happening within the evaluation period. And what I can say is that the evaluation period is usually in hindcast. We're looking at historical data. So we are modeling backwards and trying to see if that insurance contract was implemented, how often would it have triggered and provided a payout to the farmer, which means that the farmer would have been covered in case of a bad event. And if the insurance contract is able to trigger a payout at different levels, it could be at 50% of the times when a bad event happens, then it passes the standard. But if not, then this is where, again, the strength of RCMRD comes in, because through this evaluation process, the team would be able to see options for improving, or what we call diagnostics, the options for improving this insurance contract. Are they using the right remote sensing data? And from this, provide recommendations for redesigning the contract. And that is still something that is in development and under discussion. But the whole goal is that the minimum quality standard provides an additional assurance to the insurance company that the product that they are providing will be effective, but also providing stakeholders such as the farmers and the governments a very simple measure of knowing whether the specific insurance contract will serve them well when they are down, that is when there is a bad event or consecutive bad events, or not. And so this helps provide an additional measure for evaluating the effectiveness of that insurance contract. So, and again, bringing in a lot of remote sensing components that would provide recommendations, for example, for reducing the costs of implementing an insurance contract, for example, using Earth observation to estimate the yields. And I don't know if Michael presented that example, but from some of the studies that have been done in Tanzania is that the Earth observation data provides a very good support in terms of estimating yields. So this means that if you look at the cost of implementing index insurance, there's a lot of bulk of work that is done in collecting data, collecting ground data. So presenting all these other options that would potentially improve the design of the insurance contract, but also improve the implementation. So all these are the options that are presented in a QUIIC package. And so maybe the next thing I can talk about is what is next. In the last 2 years, as I've said, there have been a lot of stakeholder engagements, a lot of capacity building on both ends. I would say that Michael said when he was delving into the economic concepts that people should not get afraid. And when RCMRD, before the collaboration with University UC Davis, was really good in the Earth observation side, the technical development in Earth observation. I think what has happened through this collaboration is that there have been a series of trainings and co-development processes that have boosted the capacity of RCMRD in understanding the economics of risk financing. And again, providing a chance for our technical experts and programmers and modelers to really contribute to the process of evaluating an insurance contract. So it has been an exciting journey, and a lot of stakeholder engagements have happened, collecting feedback and trying to understand how this would fit into the whole insurance contract evaluation process. And what is next now is that, as you've seen, one of the requirements is data for evaluation. And so what is next is that through this forum and through other engagements that are going on, strengthen the networks and collaborations for data collection and acquisition. In Kenya, through ICII, there is already an ongoing initiative to strengthen data collection for livestock insurance that was launched this year called Dirisha. There are ongoing efforts that are seeking to fill the data gaps, which is one of the biggest challenges in insurance implementation. And so leverage on these networks, but also create confidence in this product so that there is willingness, and there's that willingness to share the data and to submit the insurance contracts for evaluation. But again, there's the opportunity to build capacity in the region on risk financing and remote sensing. Realize that while RCMRD was very good in remote sensing, we've had our capacity built on risk financing and the economics, the in-depth economic concepts. And so the next step is to build modules, training modules, targeting insurance technical teams so that they are able to understand this other side of remote sensing and how best these indices can be integrated into insurance contract design. Again, what is planned is a market level study on the effectiveness of the QUIIC certification. As I've said, we've been conducting some pilot evaluations of existing contracts. And so once that is effectively done we've begun certifying new products, then we begin the market level study on the effectiveness of QUIIC. But also the most important part is that already through the engagements, we've been engaging most of the partners in East and Southern Africa, and while the contracts that we've been evaluating are from Kenya, we hope after these studies to scale up the implementation of QUIIC and say to Africa, again, because our reach goes beyond the East and South states. So I'd like to stop there and pass over the mic to Glenn.
Okay, thank you very much, Lilian. As I mentioned to everyone earlier, Hassan will not be able to join us, but Michael will make a few remarks about some of the issues that arose in Kenya, I guess talking about IBLI, history of IBLI, and maybe CLIP. But Michael, over to you.
Okay, yes. Lilian, could you stop sharing your screen, please? So Hassan prepared a set of slides for us, and as Glenn told us, it's quite unfortunate that he cannot join us. But let me say just a very few things. Now I can't find his slide. Where did they go? Anyway, they've disappeared. But let me just say very quickly then, Hassan's slides will be published or put up there. And what I really would like to emphasize is Hassan has been one of the real champions in Eastern Africa of this kind of work. He was the founder of TIA, Takaful Insurance Africa, and they became quite involved early on with the livestock insurance that I was actually referring to in my own comments. That was a contract that was designed. There's been questions about data. We were very fortunate to have had historical livestock mortality data in East Africa. A contract was designed not using quite the QUIIC standard because we hadn't thought about the problem hard enough, but something related to it. That project went forward with a design that was based on satellite readings showing that those were tolerably good predictors of actual livestock mortality. Hassan and his company were the absolute champions of making this work. I know Hassan often talks about the missing middle. That is, sure, you can design a contract and then you've got people on the ground, but how do you connect them? And in places like the pastoralist regions in Kenya and more generally across the Sahelian region of Africa, people are often very remote. And Hassan and his company did quite a lot of innovation in terms of devising electronic ways of transferring funds, of collecting premium, trying to find effective ways, cost-effective ways of reaching out. He's a big believer in the quality of the contract because he's been on the ground. He understands what people confront, and I think, like any of us who work in this space, he's absolutely horrified by the prospect that an insurance contract his company might sell actually lets a person down in the time of need. So Hassan has been, as I say, a real actor in this space and for me, a real inspiration in terms of trying to really bring this together. Let's put some concepts together and let's push it out there so that companies such as Hassan's can actually have something to rely upon and to certify and say to the market, yeah, we've done our homework, we've been certified by, say, Lilian's group at RCMRD, and this is something you can count on, and this is the characteristics of the contract, and we know what it is. So I'm really sorry that you don't have Hassan himself to hear from. He's a very powerful speaker, and I certainly wish him and his family well in this time of loss that they've had. So let me pass it back to Glenn, and I guess Munya will be our next speaker. So thank you very much.
Thank you, Michael. And just indicating to those people who've been sending questions, I'm collating those and we'll be asking those questions for Michael and Lilian in a little bit. But right now, Munya, it's up to you. Tell us about Uganda and what's going on there.
Right. Thank you, Glenn. Good evening or morning, wherever you you might be. So I'm going to talk about from the Uganda perspective in terms of on the government implementation, and also what are the issues that, on a practical sense, that we have had to deal with in Uganda in our own implementation of the scheme and the index insurance. So for those that also attended today's morning session, some of this I'm going to repeat to just give a perspective of what who we are, the Agro Consortium, so that people can understand how we operate and how that the liaison between the government and the private sector, how that works. So the Uganda Agriculture Insurance Scheme started in 2016 in July, where there was a realization from both the insurance industry that for things to move and to scale up, they needed to have an intervention from a government and with the help of the public sector to come up with something that could be sustainable, or something that could make the scale up more feasible. So the private sector, through the insurance association, approached the government and then asked if there could be a scheme where farmers could be helped to mitigate the financial losses that they were encountering. So this is how the Uganda Agriculture Insurance Scheme was born. So its aim is to try and mitigate the financial losses that are suffered by the farmers due to the different calamities that we talk about, and then the government in turn provides a premium subsidy depending on the level of the farmer, whether you're a small-scale farmer or a large-scale farmer, with the small-scale farmers getting 50% and the large-scale farmers getting 30%. The idea was to encourage more of the small-scale farmers to insure. So the small-scale farmers are insured through a weather index, which is the topic, part of the topic we're talking about. So most of these farmers have been insured. 90% of the farmers that we have on the scheme are small-scale farmers, and they've been insured with weather index. One of the one type of weather index, the relative evapotranspiration index that we are using, currently using. So to make sure that the implementation was smooth, and also that the farmers would actually understand the products, since we're talking insurance itself is a complex subject to everyone. I mean, to most of our consumers. We had to make sure that there's enough sensitization, awareness, and process flow, so everyone is carried on board, so that the scheme can have a successful implementation. So the stakeholders for the scheme, on one side, the public sector, which is through the Ministry of Finance, the Ministry of Agriculture, with Bank of Uganda, and the agencies, some of the government agencies like the Insurance Regulatory Authority, and the National Meteorological Authority, and you also have on the private sector the farmers associations themselves, since the product was being made for the farmers, and the cooperative unions, Then you also have NGOs and other service providers, those that would provide the monitoring services for the weather index products, and also those who provide design of those products, and development partners, where mostly they would also give in funds or grants to ensure that there's enough awareness and sensitization, and also to pay for research and development of the weather index products themselves. So
Munya, Glenn here. Sorry, do you want to share your slides with people, because I know you've got some slides that are covering this material?
Oh, I thought they were actually showing.
It's okay. You still got 5 minutes, but just that might help people follow along.
Okay, let me just share them. Actually, I thought they were showing.
No, they're not coming along. They just expand them, and that looks great.
Okay. So, right, I think you can see that now.
Yep.
Yes. So, the Uganda, the Agro Consortium, in the end, is the ultimate insurer of the scheme. But the consortium itself is a consortium of 11, currently 11 members, or 11 insurers who are members of the Uganda Insurance Association. These were the members who agreed to, or were comfortable or had appetite to do agriculture insurance. So they decided to come together as a consortium to insure agriculture in Uganda. This was also for various reasons, to make sure that there was also a bit of standardization, especially of the processes of how to onboard for the scheme, and also how to pay claims when they do come. So the consortium then also is administered by its own secretariat, which now also acts as a liaison between the government agencies, the ministries, and on one side, the regulator on the other side, and also the insurance companies themselves. So even to how to manage and administer the premium subsidy comes through that secretariat of the consortium. So the consortium itself works on a co-insurance basis with and with support from the leading reinsurers here in Africa, and also some of the big world international reinsurers are on the project, on the scheme, to make sure that there's enough capacity to insure the risks. Now, to talk about the actual issues, if we to go now into the practicality of things. First of all, if I talk from on the government implementation side, is obviously what the government wants to look at is to say, should there be any losses that would happen, the product should perform. And as previously Dr. Michael and Lilian have said, some of these times there are those false negatives that come in, and sometimes also to do with the design of the product, you might not be able to have claims paid where some of the consumers have actually suffered the losses. So those are some of the challenges that you start to get. But also at the same time, because it being a new phenomenon, weather index in this part of the of the world for us. Relatively new. We started the first products in 2013, I think. You would see that as it was growing, a lot of other companies start also get very anxious to see if they can enter into that market, because they perceive that there's a lot of income in this, but most of them are not equipped to handle the complexities of the product. So some would see that some actually launched some products even without any monitoring agents or any monitoring process or procedure or method that was there, but having just seen that there could be a possibility of them writing onto this business and having some income. This, unfortunately, for Uganda, had quite a devastating effects on the perception of agriculture insurance for most of the farmers, especially in the eastern part of the country, because some companies went there and sold these products which didn't have any backing of how they were going to be able to monitor, and also they didn't have any sensitization and awareness programs to make sure that the consumers understood what the products were about. So as soon as things happened, as soon as the premiums were collected, that was the end of the farmers seeing some of these companies, and after they suffered the loss, they didn't even have anywhere where to get sort of a reprise or to complain on at that point. So one of the reasons the consortium was formed was to avoid such, because with a memorandum of understanding among the members, they can have checks with each other, checks and balances with each other to make sure that this does not happen. And that's why also the regulator was roped in to just make sure that all the products that are being sold are also approved by the regulator, and also even the premium subsidy itself, we are not paying ghost beneficiaries. That the regulator actually checks on what if the consumers that have been put as beneficiary actually exist and have actually taken that product. At the same time, data issues have also been a problem. So as we all know, designing products always needs data for us to have quality products. So that was also at that point resulted in low quality products being offered in the market, even for those that had tried to do it properly and within the right channels. At the same time, a unique local issue would have been also lack of skills and expertise to actually design some of these products, since they were new in this part of the world at that particular time. So you needed to be able to have the right skills, the right resources, and to be able to help with the design. If the design was done externally, you also needed internally for people to also understand and be able to say to apply it and make sure that it's also done and explained well locally. So most of these led to the low quality products that started in the beginning, before the advent of the consortium. And like I said, some of these failed the beneficiaries, not because they were not supposed to have been payouts, but payouts were actually there, but the products had not been designed well at all. Then like I said, in that area, is specifically in the area in the eastern part of the country, it has taken us from that time in 2013, only recently, the last 18 months or so, to be able to go back and convince the same farmers to get back on board and to show them that now these products, this is how we've changed them, how they can perform, and happy to say that the last season they've seen some of them perform, because unfortunately we had a bad season in most parts of that eastern part of the country, where we started with a drought and we ended up with excessive rainfall. So at least the product then performed to some level, not the level that would be of satisfaction to the farmers, because again, since it's a government scheme, the government would have want a certain level of rating to be offered to the clients, and to compensate for that, you would play within the product design to offer maybe deductibles to reduce the rate, the overall rate that you would charge. So the main thing is that there was still a bit of satisfaction, because payouts then were being done. So we've been able to sort of get them back on board, those people that we had lost at that time. But it has taken us, like I said, over 6 years to get back some of these people. We also believe that from what I've been saying, the challenge being the political pressures on premiums, like I said, also sometimes also the claims issues also come in the government schemes, because, for example, yes, the product has been set at a design where maybe it starts to only pay off at a certain strike point, which might be okay in terms of making sure the rate is okay, but then that means also at that point some of the small losses might not have been paid, will start also becoming an issue. And being a government scheme, it's possible that you can get pressure to actually just pay some of those, yet the design does not is not allowing for such payments. And I believe that having certified products means that you can also just get this protection for products, so that there's no undue influence, because now you're looking at when you're looking at the government, you're saying these are certified products. They've been looked at holistically, comprehensively, and not just by the local entities or the local companies, which are the ones offering, but they've been looked at by by an independent quality control entity, say, for example, and when it's said that the product is not performing or not paying out at that point, there should be that belief that yes, it's not paying because it is the right thing, according to how the product should be, not according to what the pressures are coming from a political kind of influence or any other influence that can come in. I think that's my presentation.
Thank you very much, Munya. Glenn here again. I've actually got a very healthy list of questions from the 160 odd participants that we've had at various times. So let me go through those. I'm also going to make sure I try to ask all of them, and I'm going to do them a little bit out of order because some of them are more general and then move down to more specific ones. So first question, I think it's appropriate for Michael to answer. And it's a combination of question from Cedric Herman and Emily Coleman. So what's the formal status setup of QUIIC? Is it a private or academic initiative? What ensures QUIIC independence? Does QUIIC only work with African countries? And then a further one to that from Emily, which is very similar. Who's expected to finance QUIIC processes if a country or institution wants you to conduct such an assessment? Or do you plan to build the capacity of other actors to use the tool? A general set of questions, Michael.
Right. Okay. Good. Thank you, Emily, and the other questioner. Cedric, thank you. Yeah. So we're actually, COVID has had many impacts, and one of which it got us knocked off course on this, because we were actually going to implement the QUIIC standard for a product from Mozambique and also one in Uganda at this time, or earlier than this time, and we've simply had to postpone it. The way this is working at the moment is the innovation lab that I direct is funded primarily by USAID, and they gave us a grant of money that would allow us to roll this out, have money to pay for the certifications, and that's what we were planning to do. We were going to do some light research around it to look at the impact of certification. Does it actually move the needle on demand? Are people happy with it? So we're in the process of constructing this. We decided to focus exclusively on East Africa initially. We have a board. The QUIIC board is comprised of about a dozen people who come from both regulatory authorities, from insurance, from the insurance industry, from governments. We have participation from the World Bank and other people that act in this space. So it's a little bit of a work. It's a little bit of a work in progress. We're trying to demonstrate the concept, and we hope that once the concept is demonstrated, then and the value is demonstrated to the private sector, that we could then work up a scheme whereby the costs of certification would be covered by the companies that ask for it. So that's where we're headed. And I think when we first planned this program, which was quite some time ago, we thought we would be further along than we are. I will mention Lilian Center RCMRD is part of a NASA so-called, it's called the CEAR network. And in the work we've been doing together to develop concepts and the kind of workflows and the programming that goes beneath what Lilian shared with us in those flowcharts, we've had participation from West Africa and East Africa and Southeast East Africa, West Africa, South Asia, and Southeast Asia, where there are also centers similar to Lilian's that are basically geospatial centers, but bringing them into this. So our hope is to stand this up in East Africa, where there's a lot of government involvement and interest, such as what Munya told us about. But ultimately, we would hope to be able to build out on the technical expertise of these centers.
Okay, that's great. That also, I think, addresses a question from Lee Johnson for Lilian. So, it's Lee, that I think your question is kind of answered that way as well. A couple of questions for Lilian. Lilian, one from, let's see, one from Maria Mateo Saprong. Is the QUIIC certification mostly targeted to insurers' industry, or do end clients, farmers, recognize and value the certification as well? I'll take each question as they come.
Okay, thank you. So I think it targets both, because it provides a standard for the insurance companies to understand if the contract would be effective. But on the other hand, it's a mark of quality that allows the farmer and the government, who are sometimes co-funding or procuring the insurance for the farmers, to understand if it's going to be effective. It's like the mark of quality that we have for other products. And if you see that mark, even without understanding the complex science behind the design of the contract, you know that it's good for you. Thank you.
Great, great. Follow-up question for you, Lilian, from Cedric Herman. Two parts. How long does the contract certification process take, and how much does it cost? And two, where do you set the threshold for certification? Should the utility of insurance be positive?
Okay. So first one is how long the certification process takes, the utility of insurance. What was the third part?
Oh, there wasn't a third part. That was just me not being able to count.
Okay. Okay, so the first part is on the certification process. Most of this, the process for certification is actually automated. I think the process that would take time is the data acquisition and processing. So if the data is available and processed, it would take less than a week to do the certification. Again, not because of running the certification process itself, but providing the reports and the diagnostics if needed. You know, if it doesn't pass, then what does this mean? Creating those reports again. And mostly, if the data is available, then much lesser time.
Okay, okay. And where do you set the threshold for certification? Is it just positive utility, some positive amount of utility, or just greater than zero? I guess it depends if you've got confidence intervals on it. I guess it depends if you've got some standard errors around the estimates of the expected utilities. Then you may want to have a bit of a buffer in terms of utility.
Exactly. So you provide the different levels of outcomes.
Okay, that sounds fine. Munya, I have a couple of questions for you. And they're still coming on in, which is good. So one question, how do you believe that QUIIC can be implemented and enforced if indeed a regulator uses it as the criteria? Do you have thoughts on that?
Yes. So like I said, again, to avoid those companies or organizations which would just want to come out there and say they are offering a product and then disappear as soon as the problems come in. It's a way that they can use this as a prerequisite for you to actually offer index insurance in the market, because like I said, we have had those incidences where someone just says they've got a product, yet no one has seen what the product looks like.
Okay, fair enough. Another question for you. You've mentioned that you also provide a relative evapotranspiration product. How does its quality, since you're talking about QUIIC, how does its quality compare to rainfall-based products based on your experience? And how easy is it to design such a product internally?
That's a very good question. In terms of how we chose to go with RE, I mean relative evapotranspiration instead of rainfall, was first of all also initially to do with our local situation, where you don't have enough of weather stations or rain gauges that you would be able to do. To cover what area that you need to cover, because like I said, this is a national scheme. So it's not based on like only one district where you can now go into this district and put all this equipment that you need to be able to do and have quality information from your rain gauge or your weather station. So we went with relative evapotranspiration because at that point it provided us with the best quality or near what we could sell to the consumers at that point. And we've been constantly relooking at it in terms of having what the ground truth versus what the products have been doing, and trying to adjust and see where it's been lacking and going on. So I think also a lot of trying to test it, like what Lilian and Dr. Michael have been talking about, are issues that we still need to keep on looking at to see how they are responding.
Okay, great. I have a couple of questions now for Michael, and then two very general questions for all panelists from Jim Jones and from George Brady to close us. So Michael, a couple of questions for you. These are relating to the amount of data, the type of data that is needed to implement QUIIC. One question from, well, two questions from Cedric Herman. How many years of data do you need to properly assess the quality of a parametric insurance product? And I'm guessing it depends on the level of the idiosyncratic risk. And relatedly, he's asking, can the quality instead of an insurance product be assessed based on the average loss ratio over a number of years? And there I'm assuming he's talking about the historical loss ratio. And then related to that, there's a question from Giancarlo Cerboncini, forgive me. What's the role of private service providers on lots mapping using alternative technologies as drone services instead of more complex, difficult to hire and expensive satellite imaging? So it's just those three questions on sort of data requests.
Okay, great, thank you. Those are great questions. Let me start with the middle one, because I think it helps clarify things. So loss ratios are sort of informative. They let you know whether or not how much money people are getting back per dollar that was paid into the insurance pool. But what a loss ratio is not sensitive to is whether that money was paid out when people were actually in good circumstances. So was it a false positive, or in fact, was it paid out when people were in sort of more desperate situations and really need the payment? So, I think we could all imagine we can have the identical loss ratio between two products, one that pays out almost perfectly and one that actually has quite a number of misfires. So the loss ratio by itself, because it's just the average amount paid out versus the average amount taken in by the company, it's not really telling us when those things happen. And that's really gets to the heart of this quality standard that in the little formula I wrote down, while a little bit obtuse, it is, when are the payments occurring and are they at the appropriate time? That is, are payments occurring when people are desperate and really need the money or not? So so it's a related concept, but it's really quite different in a very fundamental way. In terms of years of data, we're being, what we've done so far, we've been somewhat opportunistic. I'd like to say that it would be great to have 10 or 15 years of on the ground data. That's often not really feasible. So we've been working on methods to backcast data where there isn't any, or find data. So the original contract that was designed for index-based livestock insurance in northern Kenya, turned out there'd been some ongoing research projects that had been collecting data on livestock mortality for a long, long time. So we were able to dredge that data up and design something based on that. In other instances, we've actually gone to farmers in the current moment, and especially with commercial crops, it's, so small scale producers, but who are primarily selling what they produce. It's actually not too hard to get them to recreate kind of what they produced in different years. Can't really do that for much more than 5 years. So what we've been looking for is some spatial variability across space, looking at predictors. And if we can, statistically, what we've done is we've tried to estimate the variability around a predicted mean. And if we can estimate that on shorter data than we might like, then we can actually simulate longer term data. So once we get a predictor and we sort of have some sense in a relatively, not a very long panel of data, but across space, we start to get a sense of what's the variability of individual outcomes. And then we can start to put something together. I would not say it's perfect, but as I was told once when I was a young puppy by someone at the World Bank, don't let the perfect stand in the way of the good. So I think in what we're doing, we're trying to be opportunistic. And the final question from Giancarlo was about drones. I think drones are potentially really quite interesting as an alternative, in a sense, a much higher resolution alternative to satellites. They're not necessarily inexpensive to operate. The satellite data that, say, Munya mentioned in evapotranspiration indices, or the vegetation indices that we typically use, those data are acquired and posted publicly for free by either the European Space Agency or NASA. They're big, they're messy to work with, but that's sort of the algorithms and programs that Lilian and her colleagues have developed sort of scrape that data down and move with it. But drones are potentially really, really interesting. My own experience, we tried to implement one once, and we got in regulatory trouble with the government of Nepal in terms of drone flying. But it's an open frontier.
Great. Let me do this. We're running out of time. Let me just ask the question to you, and then we can maybe continue a little bit because we have a few people just to finish off, Michael. And this is a general question from Jim Jones and also from George Brady, or at least apart from George. A lot of what QUIIC is about is equivalent in insurance regulation to the actuarial certification. It's saying if this product operates as intended, it will be a good product or a bad product, or to the degree of quality of the product. To what extent does it beg the question of literacy or comprehension of the product? Because you might have an extraordinarily sophisticated product with lots of triggers and lots of satellite imagery and a little bit of ground proofing here and there. And if nobody understands it, or they misunderstand it as an investment product rather than an insurance product. So to what extent does QUIIC incorporate those issues of literacy and understanding in assessing quality, or is that something that's like an additional component of quality beyond what you're planning to do?
Yeah. So the way that's a great question and set of concerns. The way we've approached it is sort of, maybe I'd say a bit piecemeal. So there are different marketing strategies, and Glenn, I know you've written on this a little bit. You can nudge people and trick people into buying stuff. One way of getting them to buy it is to enhance their understanding and let them understand the ways in which it works for them. But we all know advertising works through other levers and mechanisms. So our idea has been to say, look, in the first instance, when products are being put out there, it would be great to have a stamp of certification on it that says that it passes at least this minimum quality standard, and these are its characteristics. And whether people fully understand that or not is a tough question. I'm actually presenting a paper later today from one of my classes I'm teaching on some work that was done in China. That it turns out that if the village leader says buy the insurance, other people who have no idea what it's all about buy the insurance. Okay, if that's the way the world is often going to work, then hopefully you're at least who's ever convincing the village leader that this is the good thing for him and his fellow farmers in the village. Hopefully it's at least meeting an objective minimum quality standard. And we have the same thing. I mean, any uptake of any technology, the village leader may say, look, we've been growing these seeds since our great-great-grandparents were around, but now we've got something that's better, and let's try it out and let's do it together.
Yeah, so, and appropriately on this day, you say, appropriately on this day, you say village leader. I keep thinking presidential candidate, and I can think of a country where that wouldn't work, but let's leave it at that point because we really are tight for time.
Let's not make us more nervous.
No, that's fine. We are tight for time. We've got to wrap up. And let me apologize if I didn't get to every nuance of everyone's questions. They were great. But we have those recorded and the panelists can get back to you. So Michael, you're going to say a few words to finish up, and then Dirk has just a few seconds just to welcome people to the next sessions.
Okay, well, good. Again, thank you. There's been quite a number of people, still 136, it looks like, sitting in. Thank you for your attention. We really, really hope, I know Emily Coleman from FAO was on. FAO actually, for one particular project, suggested or required the person who's designing the contract to get certification. So that's sort of the next point is, what are the entry points? How do we create the market for this? And I think when governments, when Munya, if AIC or others, if they're helping facilitate the design and the introduction of products, holding themselves and holding their providers to a quality standard, I think is really important. So I'm super excited. Many of you may be familiar with the ARC, the ARC. It's a sovereign risk pool, but they're moving into micro level insurance within Africa, which I think is very exciting. And if this African Risk Consortium, sorry, I found the acronym, if the ARC were to actually, as a major player in this space, were to say, okay, yes, we're going to help develop these products, but we'll demand quality certification as part of it. That's really what I think we need. And I think people will begin to expect it. Again, our lives are filled in many places with these kinds of voluntary certifications. And once they become known and expected, if it's not there, people want to know why not? And so that's our goal. And so I really want to thank, as you've seen, we're not as far along as we had imagined we would be, but the support we're getting from people like Munya, like Hassan Bashir, especially from RCMRD, has just been totally remarkable. And it's great to see, the interest that we have in this topic, because I think we would all agree it's really important to get this right. And Glenn, thank you for moderating us and keeping me from droning on any longer than I already did.
That's okay. And Catherine corrected us that Emily's with IFAD and not FAO, but the general point is made. Dirk, you had some final words.
I have not much to say other than thanking all of you for getting this wonderful session together. I again learned a lot. I have heard many things, but there's always something new. And I would like to see where that certification process goes, and hopefully that will be implemented in many countries and used and further developed, because I think that is really necessary. Because as you mentioned, Daniel Clark, he once said, well, the best thing with index insurance you can do is not to buy it, because usually you're better off without that than with the index insurance, because you don't get any payout and you have spent your premium. Hopefully that is not true, so we need to look into if that's true or not, and it would be good to come up with a certification which then the client also understands and trusts, because trust is one of the key topics. So thanks to everyone, and I would like to invite all the participants to tomorrow's session. We'll talk on a broader scale, on a broader perspective, how to reach scale and develop inclusive insurance markets. 4 more very interesting sessions, so stay tuned, log on, and thanks to all of you.
Great. Thank you very much, Derek. Thanks, everybody. Take care. Bye.